Stock investing has layers of complexity that many people overlook or misunderstand. Here are some lesser known insights and considerations that can change how you approach stock investing. 1. Emotions drive markets. The stock market is influenced heavily by investor psychology. Fear and greed often lead to irrational decisions, driving stock prices above or below their intrinsic values. Being aware of this can help you avoid panic selling or euphoric buying during market swings. 2. It's about risk, not just returns. Many focus solely on potential returns without considering the associated risks. Understanding concepts like beta, volatility, drawdowns, and correlation can help you build a balanced portfolio. 3. Time in the market beats timing. The market. Attempting to predict market highs and lows is nearly impossible for most investors. Staying invested and letting compounding work over the long term is often more effective. 4. Dividends play a massive role. Over the long term, a significant portion of total stock market returns comes from reinvested dividends, not just price appreciation. 5. Most growth happens in a few stocks. A small percentage of stocks drive the majority of the market's returns over time. Missing out on these winners can significantly impact your portfolio's performance. 6. High returns often come with high risk. Stocks that offer exceptionally high returns, e.g., penny stocks or highly volatile growth stocks, often have a higher likelihood of failure. Risk management is key to preserving and growing capital. 7. Cheap. Stocks aren't always a bargain. Low-price stocks or those with low price-to-earnings (PE) ratios might indicate underlying problems, not value. Perform a thorough analysis before assuming something is undervalued. 8. Index funds often outperform active investing. The majority of actively managed funds fail to beat their benchmarks over the long term due to fees and inefficiencies. Passive investing in index funds can be a simpler, lower-cost way to grow wealth. 9. Market corrections are normal. On average, markets experience a 10% correction every 1-2 years. This isn't a sign to panic, but an opportunity to buy quality stocks at lower prices. 10. Taxes and fees matter more than you think. High trading frequency can erode profits through taxes and transaction fees. Investing with tax-efficient strategies, such as using tax-advantaged accounts, e.g. IRAs, can significantly boost returns. 11. Economic growth doesn't always equal market growth. A strong economy doesn't always correlate with a rising stock market, as markets price in future expectations, not current conditions. 12. Diversification is both an art and science. Diversifying across sectors, regions, and asset classes reduces risk, but over-diversification can dilute returns. Focus on quality over quantity when building your portfolio. 13. The power of dollar-cost averaging. Regularly investing a fixed amount, regardless of market conditions, smooths out the effects of volatility and lowers the average cost of shares over time. 14. Earnings reports can be deceptive. Companies often manipulate earnings to meet expectations, e.g., by delaying expenses or accelerating revenue. It's critical to analyze cash flow and debt for a clearer picture. 15. The market doesn't care about your plans. The stock market moves on a vast,